Good afternoon, everyone, and welcome to another weekly edition of State of the Market brought to you by Finom Group and me, Seth Golden. Quite the tape we have here today on Thursday afternoon as we've watched the 10-year yield shoot up above 1.50, 1.60% here today. Was that the blow off the top moment in the 10-year Treasury? Remains to be seen. It certainly felt that way as it's been climbing pretty much since the new year started in a more parabolic fashion, something that we've long since anticipated. We knew yields were going to rise. We knew that the strength of the economy, the reopening was going to find analyst estimates probably too low when it came to their full year 2021 10-year yield tracking and whatnot. Most analysts had a year end at about 1.5% on the 10-year. We've already surpassed that as of today. A lot of this is predicated on, quite frankly, analysts were too low. That's the bottom line. Their GDP outlook was simply too low. I think the consensus estimate for the first quarter is just around 4%. It's probably going to come in around 6%, if not a little bit higher based on what we've already seen in the way of retail sales, consumer spending, what we have in the personal savings rate, what we see going on in the housing market. Estimates are just too low. Markets are forward discounting mechanism, be it the equity market or the rate market, the bond market. And the bond market is simply trying to establish its footing with respect to how fast this economy is going to come back here in 2021. So, most of the time we look at indexes. We're looking at equity indexes when we do our weekly state of the market. And unfortunately, here's another state of the market where we have a severe, drawdown intraday. It seems to chase our video recordings for the week. Not my fault. We've tried to do them on Friday. What can you say? It finds us on Friday, finds us on Thursday. It just seems to find us. So with that being said, we're going to, dive into some of the historic data regarding, what happens when yields rise. Should this be something that investors should find fearful, storing away cash, worrying about a more prominent correction? And what I would say to that is you shouldn't be fearful if you have a game plan. You should look at any drawdowns as an opportunity to put capital to work and to execute your game plan. Part of your game plan is to sit on the sidelines. Just remember, scared money doesn't make money. If it's investing capital, need I say more? Invest it. With that, let's go to our weekly state of the market. Check things out. Okay. So this quote from the chart report came from Jesse Livermore there. Wall Street never changes. The pockets change. The suckers change, the stocks change, but Wall Street never changes because human nature never changes. It's very rare. We're creatures of habit. So in that sense, I tend to agree with this quote. And market data is very repetitive. When we look at historic data, it does prove quite repetitive. Sometimes it rhymes more than it repeats, but that is also validation of human behavior, as the market is an expression of human behavior. It's a huge advantage to recognize that you don't know what the market's going to do next. I see people trying their best to, predict the next move in the S&P, the next move in the Russell, the next move in the financials. The reality is nobody knows what's going to happen next. But more importantly, that's your advantage. I can't emphasize enough just how powerful it is to know this and to also remind yourself of it every single day. Everyone offers their best guesstimates and nothing more, guided by hopefully the weight of the evidence approach to the markets. This week, we've been buying these dips. What gave us the confidence to buy the dips in the market? We had a pretty rough session on Tuesday. Wednesday opened the same way. Here we are on Thursday with another rough session. But we've had some severe bounce backs as well on the intraday basis. On Tuesday, we came all the way back. On Monday, we bounced all the way back. We are still down here on the week, but what gave us the confidence is what we saw last week on Friday, which was another down day for the S&P 500. In fact, the S&P was down, I think, 5 or 6 days in a row coming into this week's trading action. But what gave us, the confidence to buy the dip is breadth. And what we saw in the way of the advanced decline line in the New York Stock Exchange, basically while Friday's session was red pretty much across the board, except for, I think, in the Dow, advanced decline lines were moving higher, which told us that there was actually more buying pressure than there was selling pressure. We dig that much deeper under the hood, we saw that while the NYSE was actually positive in advanced decline, so was the NASDAQ, and breadth, meaning the declining versus advancing volume, was like, that's like 3 to 1 there on the NASDAQ. A little more than 2 to 1 here on the NYSE. So even though we started out in rough shape here in the new week, breadth was strong, and that told us that this is still a market with positive sentiment. They're not buying large caps. They're buying small caps. They're buying cyclicals. They're buying financials. They're buying mid caps, but they're not buying large caps, and that makes it very difficult for the indexes to move higher. But underneath the surface, it tells you, are investors afraid of something? Are they selling everything, or are they still buying, but it's just not reflective in the indexes? And that's why we look at these gauges of the advanced decline lines for not just the NYSE or the NASDAQ, but also the S&P 500. We saw the S&P 500, the advanced decline line hit a new high last Friday. Again, breadth, we know that breadth leads price. It's just a matter of time before we hit new highs in the indexes. Do we know when we are? Well, usually it's within, a ballpark of 3 months that you hit a new high, after you've hit new highs in the advanced decline lines. It can be the next day, it can be a week, it can be a month, but it's usually within that, 3-month window that the indexes hit new highs after the advanced decline lines have hit new highs. Because again, breadth leads price, and that gave us the confidence to buy the dips. Something that I captured from Chris Dover of Pollinate Trading, he put out this note also over the weekend to members and folks that receive his newsletter. And what he says here is really interesting. Right now, I'm not interested in how we trade from here. That's what is really important. Not that we move to the bottom of the channel, but what we do with it, right? Because we had a huge drawdown in the NASDAQ coming into the week, like 500 points we opened lower. He says, remember, when the best sell setups, right? They were selling into the NASDAQ. It was down 500 points. When the best sell setups in the world fail, that is the market telling us that we are in a bull market and to buy the failed sell setups. Hoping to have Chris, guest host with me in the next few weeks here on the weekly State of the Market. But this was just a fantastic note. What happened that day? Well, people bought that dip. And we had a really nice rally on Wednesday as well. So really good notes there. Good analysis there from Chris Dover. There are a lot of experienced traders right now running victory laps about how they shorted top tick on the market. Odds are more than likely they didn't. They shorted a natural pullback in an uptrend. Chris also goes on to say, I say the odds are likely that we reverse and drift higher on low volatility moves. And that is exactly what happened. That is what happens in a bull quiet market regime. The best sell setups fail and price resolves higher. Chris and I, we look at things through a different lens, but we generally arrive at the same conclusion. Buying the dips based on breadth, based on other metrics and other indicators. Speaking of historical data, which is another type of indicator, this was one that we have been playing with over, the last month here in February. Remember when we started out February, the first week of February, the S&P 500 was green all 5 days and finished at an all-time high. This was the 20th perfect week like that since 1990. Returns out 6 months seem about average. Average return 6.2%, higher 78% of the time. A year later, though, after this particular signal, stocks are higher 89% of the time, up 15% on average. What's more pertinent to us right now, however, is next week will be 1 month. 1 month from this signal. Remember, it was the first week of February that we were perfect on the week, meaning every day was green in the S&P 500. So the first week of March, if we're going to have a 0.52% on average return based on this study and up 74% of the time, we've got to get to 39.03 by next week. We did it just the other day, but obviously we've pulled back in here today. Is this study going to give us that 74%, or are we going to be on the 26% of the equation there? Remains to be seen. We do align with probabilities, though. The more you align with the probabilities, the greatest probability, more often than not, you're going to have that greater return. Yes, sometimes it doesn't work out. We might fall into that 26% camp. But again, it's about aligning with probabilities. The more you do it, the greater the returns are likely to be. Here's another study we talked about, I think a couple weeks ago, actually, because I remember we traded in this really narrow range for like 4 sessions. We didn't go anywhere, really tight, like 7 points here, 10 points there, back and forth, unchanged on the day, up 2 points on the day in the S&P 500. I'm like, what's going on here? So I called up my friends over at Nautilus. I didn't call, emailed my friend over at Nautilus Research, and I was like, anything like this you guys have in your studies? And they came out with, some times that it has happened in the past, going all the way back to 2001. So pretty much just looking at the turn of the century. We've got 1, 2, 3, 4, 5, 6, 7 samples. It just happened on 2/11/2021. The next week is down. Guess what? The next week after this happened, we were down. That was last week, folks. We were down 0.71%. Guess what the percentage rate on average after this signal is to be down? 0.70. We exacted it. We were down. You're down 81% of the time even. It might have signaled that the market had kind of exhausted itself, right? It got up to 39.50 on the S&P 500. And then what's the impetus to buy, right? What's the impetus to buy? But here we are this week, which is 2 weeks after this signal here, right? 4 days of narrow range, 4 days there. We basically went nowhere. In week 2, after this signal, the market has been higher 100% of these signals. On average return 1.87%. I'm sorry to say, folks, but this may be the first time that this signal goes awry, right? 7 signals in the past. This one might be the one that drops the average down. Because as of today, and let's see where we are actually, get a refresh here. We're down 68 points now on the S&P. We're starting to fade again. And that takes us to, on the week, down 0.71% here this week. So we need a robust day tomorrow, obviously, just to get back to even. We need a really strong day. It doesn't look like this study is going to make it for us, folks, but remain optimistic. 2 weeks ago, one of these issued. That's all the notes here for this particular study. All right, everyone would love to be able to pull their money at the exact top, right? Avoid all major market corrections and reinvest at the bottom. But unfortunately, there is no holy grail timing mechanism, and market volatility is the cost of admission for stock investing. That's the price you pay for volatility in the market. It's our jobs as investors to focus on our long-term goals. This is quotes from Ryan Dietrich of LPL Financial. Drawdowns and bear markets are part of the path to get there, to that end result, to achieving your long-term goals. And limiting that latest shiny object from affecting our decisions is key to any investment strategy. If an investor pulled their money from the market during last year's volatility, right, back in March, February, there have been a plethora of reasons to be hesitant to reinvest that money. And the subsequent bounce from the lows happened like that, meaning they may have actually, once you pulled your money, you were probably forced to pay higher prices than where you originally sold. Again, there's no holy grail for timing the market. It's a really poor discipline. Stay invested, have cash on the sidelines to add leverage, add exposure to the market. When the market goes on sale, guess what? The market's on sale, folks. We've already had almost a 4% correction from the peak at 39.50 to the trough on Monday, 38.05. A 3.8% correction, almost a 4%. And that'll be, almost 4% plus corrections here this year. We had one in January, 4.5%, and almost a 4% correction here again in February. And what's the talk of the town? It's yields, right? As yields go, that seems to be what's causing this additional what we call VAR shock, volatility adjusted risk shock to the equity market. This chart right here, I actually tweeted out on February 23rd, so Tuesday, and I was looking at where the probabilities lie for the 10-year yield to go. And it seemed to be like there was gravity points here over the last 5 years that got you to 1.45%. Sure enough, we got to 1.45%, got to 1.5%, and I think we overshot when we had maybe a blow off top there, 1.6% on the 10-year yield here today. Same chart, also by Nautilus Research, pretty much came to the same conclusion, 1.45%, which is also the 0.618 Fibonacci retracement level. So, what's going to happen with yields? The consternation is, the Fed may have to step in and lower rate. Everybody's got a thesis on what the Fed is going to do, taper, tantrum, this and that. These notes here are from Ed Yardeni, who very well respected analyst for, last 20 plus years. Both Powell and Treasury Secretary Yellen have said that they have tools to deal with inflation, which I believe they do. The only tool that has been used in the past to fight inflation was higher interest rates, which is not true, resulting from the actions of the Fed or the bond vigilantes. Higher interest rates often lead to credit crunches and recessions. And that's true. You keep hiking rates or rates move higher, it tends to create tighter financial conditions, tends to create restrictive lending practices from the big money center banks and regional banks. And then there's just not as much, money flowing through the economy. So Ed Yardeni goes on to say, I would never doubt the Fed's toolbox. Good on you. Oh, actually, those are my comments. Moreover, we have examples from the 1940s, World War II era that suggest the Fed has a strong toolbox, which includes yield curve controls. Now, our Finom group members know that I've been talking about this for a good year, if not more than a year now. We were talking about this before the Fed started its, QE mechanism once again back in April. I'm of the belief that there's never going to be a rate hike or even a rate cut again yield curve controls will do that much, they'll be that much more effective. I think the Fed has drawn the conclusion, it really doesn't matter what we do to rates. Rates eventually go to zero. I think they've come to that conclusion here over since the financial crisis, in my opinion. So here's what the U.S. inflation did between 1941 and 1951, right? Talking about the last time yield curve controls were put in place was during the World War II era. And this was all items consumer price index over 12-month change from 1941 to 1951, peak to trough, another peak here and move lower. I mean, over that decade, CPIs basically moved lower, trended lower. How did the Fed manage to control inflation during World War II? Yield curve controls, a lot of good talk here on that. I think that's where the Fed will be. Not in the near term. The Fed is not going to react to, possibly this overshoot in the 10-year yield in the bond market, immediately. They're going to wait and see how things settle out. Again, the bond market is simply trying to price in what is potentially going to be a faster and stronger economic recovery. That's normal. This tweet here from Convexity Maven also highlights, that we really haven't seen, the move, which is the volatility index of, the rate market. We really haven't seen it spike up, as yields have been rising. I think that goes away today. We do see a lot more volatility in the bond market here today. But it did get me thinking, what happens when we see the yield curve widening out to the degree it has? It got to 128 just the other day, and it's going to be at over 130 basis points when today is over and done with. So we've seen a dramatic, and rapid expansion or steepening of the yield curve. The yield curve is the spread between the 2-year and the 10-year. Again, it got to about 128 basis points just the other day. Now we're over 130 basis points. So let's see what happens to the S&P 500 when the yield curve moves out 100 basis points or better. So here's the S&P 500 in black. Here's the yield curve. And we see it expanding once again here, or steepening to almost 130 basis points. So the chart below, or the table below, shows weekly data points of the spread between the 10-year and 2-year. Earlier this month, the spread went from 100 basis points to over 128. This table right here, the S&P 500 after the yield curve crosses above 100 basis points. That's just when it gets above 100 basis point, right? It basically hits that mile marker, if you will. And this is for the first time in a year. It has to do that for the first time in a year, this study. And this goes back to 1980 to the present. It's a little unnerving that the 2 times we've seen this happen since 2000, the S&P 500 was down almost 10% and 40% over the next year. Here's the 1-year returns. Here it happened in 2007, and here it happened in 2001. Those were the last 2 times. If we go further back in time, returns were actually very, very good. I think the problem here was obviously the dot-com bubble bursting. The problem here was obviously the financial crisis ensued. So at least we know, why this proved to be so bad. Because in reality, after you cross 100 basis points on the yield curve, or the spread between the 2 and the 10-year, the 1-month return, very strong. 3-month returns, very strong. 6-month returns, so on and so on and so on. But these two occasions had some anomalies or exogenous events, if you will. Both of them were highlighted with excess. Excess in the financial market, excess in the housing sector, excess in leverage in 2007, housing 2007, excesses in the market during the dot-com era, granted. But every other time, the returns are pretty darn strong. So we'll see. We'll see if we got an anomaly this time or if this is heralding something good to come. All right. So this table, the table above summarizes the return in the table above. The returns look great out 2 to 3 months. So it takes the averages of all of these occurrences, takes the averages. The 1 month return average is 4%. 3 months, 5% plus. 6 months, 1 year, not that great, but the median return is very strong. What I tend to, lean on is the positivity rate. The 1 month return and the positivity rate is very strong. It gets weaker though over time on the positivity rate, mainly because of these two outliers here. All right, so here's another way. The 52-week returns win. Let's see if it's better for stocks for the yield spread to be narrow or wide, right? 100 or more or less. What about when the yield curve is inverted, right? We have negative. We're negative on the yield curve. So we broke down the returns into 5 different brackets, as you can see here. 51 to 26 basis points, 26 basis points to 100 basis points, 100 basis points to 166 basis. That's the range we're in right now with the yield curve at 130. So we're right in the middle here. That's where we are. Based on the table, a wider yield spread has resulted in better stock returns. The average return, the 52-week return is almost 3.5%. The percent positive is 63%. Not that great. Can't lie to you. Again, we're trying to break it down as many different ways as we can. We don't have grand, sample size. It's just 1, 2, 3, 4, 5, but it's noteworthy. And we are at pretty good levels when it comes to the yield curve. One of the things that is kind of highlighted through the yield curve, you can see play out in the financial sector as the big money center banks and regional banks tend to do better as the yield curve steepens because they can earn greater net interest margins on their loans. All right, so another way to think about, yields rising is, it's normal. The change in the 10-year treasury yield from yield lows during most recessions is signaling or validating the bull market recovery. Here's all the times in the past, 1981, 1982. And we know that we had a really strong market from 1982 to 1985, 86. And finally, 87, we had kind of a flash crash, if you will. The 1990 to 91 recession, you can see, and the market took off from there. The 2001 recession, here we had liftoff, but that was kind of a fake out. And we didn't really start a new bull market until 2003, a cyclical bull market within a secular bear market that started in 2000. So for those people who are interested, now is the time to be concerned about, whether or not now is the time to be concerned about a big crash. Chris Zaccarelli, who's the Chief Investment Officer for Independent Advisor Alliance, he thinks, now's the time to put cash to work. The time to worry will come down the road when the Fed does actually raise rates to head off any actual or real inflation. For now, the discussion around inflation is just beginning. That's to be expected as history shows that rising rates are normal during recoveries. LPL Financial puts their 10-year yield target for 2021 at 1.75%. We believe more good news on the economy will continue to push yields higher, but there are also forces in play that may help slow the pace down. Right now, it's about the rate of change. Most people are talking about the rate of change is more problematic in the 10-year than the actual level, because the actual level is still extremely accommodative for all financial and all economic, growth. It's still extremely accommodative below 2%, but it's the rate of change, how quickly it's moving to the upside, that is kind of, concerning to investors. Here's Bank of America, global research. They see the 10-year yield achieving 1.5% near term, but also ending the year at 1.75%. One thing to keep in mind, while we might be having this, second VAR shock, volatility adjusted risk shock, if you will, based on the movement in the rate market, keep in mind that equities and bonds tend to move up together over time. Again, that's what this chart right here shows from Bank of America. Falling yields, if they're falling, from 10 basis points, if they're falling from 30 basis points, if they're falling 90 basis points, if they're rising, which is the light blue, it doesn't really matter. Here's the 12-month returns in the S&P 500. This is rising yields, about 10 basis points. The S&P 500 has fallen 50% or more when that has happened. But it has also risen 50% or more over a 12-month period when that has happened. It really doesn't matter. You get interim VAR shocks. You get, consternation, which allows for, investors to take profit, digest the gains. And folks, we've had a lot of gains in the S&P 500, over the last 10, 11 months since the March bottom. We're heading into March now. We also know that when rates are rising, it doesn't tend to produce strong gains for the technology sector. Tends to impact that sector pretty well. Consumer staples, utilities tend to perform poorly as well. They're dividend yielding stocks in those particular sectors. And when yields are rising, now you have competition for dividend. So here's a chart of the relative performance of the technology sector ETF versus the S&P 500 ETF. So the XLK versus the SPDR. And as you can see, since about July, this peaked out here. The relative performance of the XLK was outperforming the SPDR. But ever since then, it's just been treading water, so to speak. As financials came into favor, bank stocks, small caps, cyclicals, industrials, that's all part of the reopening trade. This is another way to look at it with the XL. This is the XLK and XLF. And you can see the financials. So we just said this is the relative performance of the XLF. So we put the XLF in front of the XLK. Financials versus technology. And since the financial crisis, we've seen financials underperform technology sector for quite a period of time. But all of a sudden, financials are outperforming. They found this new bottom. Could we have, 10 years worth of, to make up for lost time here? Could we have 10 years worth of the financials outperforming the techs? I'm doubtful of that. I'm very doubtful of that. Financials don't have the same free cash flow as the technology sector. And they're just not, they don't have the PEs because of the cash flow. One could look at this as possibly another false bottoming. We had this false bottom here, made lower lows. This looked like another bottom. Nope, kept going lower, grinding lower. So I think this is just another false start in this relative ratio performance from the financials and the technology sector ETFs. I think what we do is possibly continue to go a little bit higher, maybe even test this area right here as resistance, and then fade. And this may take a year. This may take 12 months or so. But I don't see financials outperforming. Sorry. Don't mean to disappoint anybody who's in financials, but that's just how I see things. So, and within the technology sector, another byproduct of the technology sector could be the the FANG stocks, or the FAAMG, including Microsoft. And we can see that they've underperformed the S&P 500 also. From about September, they've underperformed, even on an equal weighted basis. Your Amazons, your Alphabets, your Amazons, your Apple, your Microsoft, Facebook, Google, and you've seen the price action in these stocks. They released incredible results on earnings. Right now, they're getting multiple compression. That's just not where the investor appetite is found right now. It's about the reopening cycle. Here's another chart from LPL Financial. As shown in the chart above, conventional early cycle leadership from financials, industrials, and energy stocks, that's cyclicals, energy is cyclicals, has emerged over the past 3 months. And we can see the top performers year to date. Energy up 18%. The Russell, which is the small caps, up nicely. NASDAQ as a whole is still up. Financials, communication services, and then technology. So that's the performance year to date. Large caps, not in favor. I mean, that's why we haven't been able to make any headway here to get to that 4,000 round number we talked about last week in the S&P 500. They're buying small caps. Look at this relative performance of the SPDR to the IWM, or the Russell Index ETF, if you will. So large caps basically peaked, back here in March. Basically in March of 2020, they peaked. The relative ratio peaked. Large caps outperforming small caps, and it's rolled over ever since. The small caps are what people are buying. Mid caps as well. But again, what's large caps? It's your Microsofts, it's your Adobes, it's your Nvidias, it's your Netflix, it's your Apple, so on and so forth. They've underperformed. This chart right here, also from LPL Financial. Stocks tend to do well after corrections. I think we all know that, but here's all the corrections going back to 1980. Corrections of 10% or greater. That's the technical, textbook definition, if you will, of a correction, is a drawdown of 10% or greater. The 1 year return after the lows, on average, a 23% return 1 year later. 2 years later, right? Because after March, we'll be in that 2 year time frame. Look at the returns, folks, 37.5%. 2010, which would be 2 years after the great financial, the bottom of the great financial crisis was 2009. So let's look at that. Here's 2009. 1 year later, the market was up 68%. We've kind of blown that away. We got to a peak of, I think, 75% return at 39.50. 2 years later, the market was up 95%. Here, 2011, 31%, and then 53%. The new secular bull market started in 2013. A secular bull market can last anywhere from 15 to 20 years. So take the corrections for what they are. They're gifts. They're gifts. We've also talked about the analog. We continue to monitor the analog from 2009 into 2010, mirroring it with 2020 into 2021. And we were supposed to have the correction start January 19th. That's where it started in 2010. The S&P 500 dropped 8.2%, lasted through much of February, and market took off again in March, made new highs. This is us right now. We're starting to curl over, like I said, from the peak at 39.50. So far, we've troughed at 38.05, giving us about a 3.8% drawdown. Is there more to come? Well, tomorrow's the last day of the month, folks, and typically we see some type of end of month selling. We also have the biggest POMO day of the bi-weekly calendar from the New York Fed, which performs the permanent open market operations, otherwise commonly known as the QE functions from the Fed. They're buying $12.5 billion worth of Treasury securities of some sorts. That's the biggest buying that they do on a 2-week period. So far, what we've learned, since April when QE started up again, is only 4 times on this biggest buying day from the Fed has the market been flat to higher. The last time the market was higher. The market was up by almost 0.75% on that particular day. But again, it's only 4 times out of 20 of these days where the Fed is buying $12.5 billion Treasury securities. What we found is that institutions tend to use this additional liquidity to sell into. And now it's coinciding with the end of the month. So I don't know. It doesn't lend well to tomorrow's end of week performance, if you will, and end of month performance. We will, as of right now, we will still be higher for the month of February. Going into March, here's what we might expect. Recent 21-year March market performance, you can see the seasonality. We tend to start off pretty decently, peak around the first week of March, and then we trend lower into about the middle of March, and then we march higher into the end of the month. So we'll see what happens. We'll see what happens there. All right, folks. Well, that's all we've got this week. Do tune in next week to our weekly State of the Market. Trade safely. We'll see if we can bounce back here tomorrow.